Time now for today's strategy session. Trade tensions and growing signs of a slowdown prompting a $2.1 trillion sell-off in the stock market. And it's called into question whether or not the recession trade is back. So is now the time to get defensive? Joining me now, I want to bring in Gina Martin Adams, Chief Equity Strategist at Bloomberg Intelligence. And Gina, what do you think? I guess when you take a look at the fact that bank stocks, you've got small caps still struggling in this environment, the continued selling that we're seeing this morning, is a recession trade back?
Well, I think it's part of the story, certainly, is economic growth has certainly created a bit of downside risk in the equity markets over the course of the last few weeks, as surprises have been negative. The market was definitely not anticipating a bit of an economic downdraft to what was already market weakness that had emerged well earlier in the year. Clearly, the tech landscape has changed dramatically. Tech was responsible for the vast majority of gains on the S&P 500 over the course of the last 2 years. So any sort of downside momentum in tech creates downside in the market, and then that got exacerbated by what we saw in the economic data. In the interim, it does look like the data is going to remain somewhat weak. We've got payrolls coming on Friday. Most forecasters reflecting the downdraft in layoffs that we saw earlier this week would anticipate a weak payroll number coming on Friday. That could take the market somewhat by surprise. I think we're going to go into a period of time where the pressure starts to emerge on the Fed to respond. And that could be very interesting, creating some volatility in rates as well. But in the interim, the answer is yes, the trade is on, and it's on to the downside, in part because our confidence in the growth outlook has been depleted over the course of the last few weeks.
Gina, what would trigger the Fed to act? What do you think the Fed needs to see in order to feel comfortable cutting rates?
Yeah, the Friday is going to be a really interesting day. So tomorrow morning, we may actually see a downward decline or a big decline in employment concerns. If the employment generally drops, if the unemployment rate rises, that is one of the indicators that the Fed follows fairly closely. So if we see growth really deplete the outlook for jobs, that could create a response of the Fed. I think it's a bit early to say that 1 month will create a response, but the pressure will start to emerge. If we start to see more initial claims rising, if we see those layoffs continue over the course of the next several months, if we see this accumulate into a job distress environment, that's one leg of what the Fed is responsible for monitoring. So if we start to see growth to really truly decline on the employment lines, then the Fed may respond. That, of course, also leads to what's happening with inflation at the same time, because, of course, the Fed has a balanced view of growth and inflation at any given time. Will we start to see inflation moderate? Because that may be the secondary key. If growth is decelerating and inflation is decelerating, then the Fed has a lot more room to act. I think it will take a couple of months, but this Friday may be an initial trigger that the Fed really has to start to pay attention to.
Is it safe to say at least some of the volatility that we started to see creep back into the market, that's here to stay, just given all that uncertainty and given the fact that we don't know necessarily, obviously, the timing of the Fed, whether it's going to act, and then the risk here that some of this econ data continues to get worse?
Yeah, the volatility is several-fold. It's not just economic data and the Fed, as you rightly point out, but it also is about earnings. Earnings confidence has been depleted. Clearly, there are competitors in the tech space. The race for AI is now a global race, not really a U.S.-led race predominantly anymore. It really is global. The result of that is competitive pressures emerging for tech. We also are seeing downside estimate revision emerge across the entire S&P 500. So beyond tech, with the exception of financials, every other sector has also produced a negative estimate revision. I think broadly what happened was we came into this year with just too high of expectations. The market was priced for near perfection to emerge in the economy as well as the earnings stream. We are now really questioning those assumptions, and that's creating the volatility at large.
Gina, let's talk about this from a global perspective. You have said that the Mar-a-Lago Accord, that intentional devaluation of the U.S. dollar, an idea that has been floated from some of the key advisors here to President Trump, that it could actually be rocket fuel for a global stock disruption. Explain that to us and exactly the risk potentially that this entails.
Sure. So we looked at former currency accords like the Plaza Accord and the Louvre Accord from the mid-1980s to do some of this analysis. We also look at the correlation between the dollar and global stocks. And what you find is in the Plaza Accord in mid-1980s, the dollar was devalued, especially versus the biggest currencies that contributed to the dollar's gains. So that at the time was the German Deutschmark, the French franc, the Japanese yen. The result of the Plaza Accord was a very sharp devaluation of the dollar, but it also was a rotation into non-domestic equity markets. In particular, the Japanese equity market soared in the time in which the dollar was depreciating. The Louvre Accord came shortly after the Plaza Accord, about 18 months after the Plaza Accord, in an attempt to stabilize the currency markets at that time because the dollar was so rapidly depreciating that it became a destabilizer for global financial markets. At the time, the yen continued to depreciate relative to the dollar, but the Louvre Accord allowed for some stabilization in the European currencies. That did change equity dynamics. But big picture, when the dollar is declining, international equities tend to outperform. We see a long-term correlation that is relatively meaningful there. So if we go into an environment where the dollar is decelerating, you can anticipate that the most likely outlook for global assets is for a continuation of the rotation into non-domestic stocks. So far this year, we've already seen European equities dramatically outperforming rest of world equities. We've seen Chinese equities start to perform significantly better as well. The U.S. has taken a big backseat, now in the bottom third of countries in terms of performance so far this year. That may be amplified by something of a currency adjustment, potentially call it a Mar-a-Lago Accord, or even just a currency adjustment that occurs organically in the global equity markets would largely favor those non-domestic equity markets.
All right, Gina, thanks so much for breaking that down for us here. Gina Martin Adams of Bloomberg Intelligence. Always great to talk to you.